Hello, in this lecture we will define accumulated depreciation. According to Fundamental Accounting Principles, WOW 22nd edition, the definition of accumulated depreciation is cumulative sum of all depreciation expense recorded for an asset. In order to understand accumulated depreciation, we need to first know which assets will be depreciated, what depreciation is, and what accumulated depreciation then is. We will use an example depreciating a tank. This is a tank that we're going to be using within our business in order to help us generate revenue in the future. Our assumption is that we purchased that tank, we put it on the books for the $257,500 purchase price. Of course, we didn't expense it. We put it on as an asset because it's going to help us generate revenue in the future. Then we know that that tank's going to go down in value. However, it's not going to go away. In year 2, there will still be a tank, but we're assuming that it's not going to help us generate as much revenue in year 2 as it has in year 1. Therefore, we want to write it down in value. However, we don't want to write down the equipment account directly like we would for something like supplies, because there's still one tank and we have to use some type of estimate in order to write it down in value. That estimate will be the idea of depreciation. So we're going to calculate depreciation. And the way we could do that is we could say the most easy thing that most people would think of in order to calculate depreciation would be, well, let's take the useful life of this and then allocate an even amount of the cost over how long we believe the useful life will be. We're going to add one more line into that type of calculation. We're going to take the cost minus the salvage value. So at the end of the useful life, we're assuming that we can then sell the tank for scraps or whatever for the $20,000, meaning we're going to depreciate the $237,500, bringing it down to $20,000, which we can then scrap it at the end of the useful life. We're going to assume this time a useful life of 4 years. So we're going to say, hey, we're going to use this thing for 4 years for whatever we're using it for in order to help us generate revenue, and then we're going to scrap it for $20,000. That means that we're going to have $59,375 in depreciation per year. So in year 1, we would have this journal entry, and we would say, okay, here's the cost of the tank, here's the accumulated depreciation. We're showing our reader the cost, how much has been accumulated in terms of depreciation. If we subtract those out, we have the book value. That's for year 1. If we did this all the way through, so years 1, 2, 3, and 4, we can see that accumulated depreciation here will increase each year. It's accumulating upward by the additional depreciation that has been applied each year, reducing the book value each year until the last year, at which time the book value is down to $20,000, the salvage value that we determined we could scrap the tank at the end of the time period. That's where the process stops. If we keep the tank, we're not going to continue to depreciate it below what we would believe the salvage value is.